fantastic. Welcome to Coffee with Markus, where we'll just have a coffee together, talk about trading, and see what's going on in the markets. And what I like to do in this show is show you how I like to trade, what I like to do, and hope that it helps you in your trading. So let's switch over to the charts. And we talked about it in previous sessions. Let me just see if we can bring up the charts. There we go. So I like to trade the wheel strategy. And if you are not quite sure what this is, there are some other videos that I did previously here on the Traders Hub. So check out the archives and you'll see it. But in a nutshell, what we are doing here is we are selling put options of stocks that we would like to own and collect premium. Number two, we might or might not get assigned in stocks. When we do, we will sell call options and collect more premium. So previously, we talked about how I select the stocks that I want to sell puts against. Last week, I've shown you an example of how to sell puts. And today, we want to focus on how to sell calls after you got assigned. And in order to do this, I want to break up UPS. So UPS is a stock that I traded. And here's what I did. A few weeks ago, I sold the 157.50 put. And as you can see, UPS dropped lower. So this means that I got assigned. And now I own UPS at $157.50 per share. Exactly the strike price that I sold puts on. So the question is, now that we own the stock, what do we do? And this is where the third part of the wheel strategy comes in. We are selling covered calls. So when selling covered calls, we actually have four possible scenarios of doing this. So the first, which is my preferred one, is to sell calls above the assigned price. So this means at 157.50 or higher, right? So for example, at 160, 162.50, 165. Because this way, as you will see in a moment, we will not only collect premium, but also benefit when the stock is rising. The second scenario is that I sell calls at the assigned price, which would be exactly at 157.50. Third, we can sell calls below our assigned price, but above our break even. And number four is that we sell calls below our break even. So right now, we don't need to talk about these scenarios, but I want to show you today where we can talk about scenario number one and scenario number two. So in order to figure out whether it makes sense today to sell calls against my existing position, we can hop over to the calculator. Now today, overall, the markets are down again. As you can see, the S&P 500 is down 0.4%, the Dow is down 0.6%, the Nasdaq is up 0.3%. So typically on down days, it's not the best day to sell calls because, we want to make sure that we are getting the maximum amount of premium. And that's typically when selling calls on up days. Now, when selling puts, it is on down days, but today we're talking about selling calls. So I'm hopping over to the calculator and I'm zooming in here so that I find the information that I need. First of all, I enter what symbol I want to trade, where I got assigned, the nearest expiration, which is October 6th. This is in 4 days from now as we're recording it. I own 1,200 shares. And right now, I first want to see how much premium can I get at the strike price of 157.50. And then we're looking for another scenario, how much premium we can get above the assigned price. Now, for me here, the same rules apply when selling calls than selling puts. And this means that the annualized RI, return on investment, I want to see it that this is larger than 30%. So let's see what happens here. And this is where I want to zoom in and show you different scenarios here. So right now, as I'm zooming in here, you see that when I sell the 157.50 put, right now I could get the bid ask is 43 by 49, so probably 45 cents, which would only give me 20% annualized ROI. So that is not enough. So therefore, I cannot sell it today. It seems that UPS would have to go a little bit higher. Now you might be wondering, why don't I sell the 155 where I can get 57% ROI? Well, let's take a look at this. If we would do this and if we would sell the 155. So in this case, you see, I get a lot of premium. I get $1.25. So this would be $1,500 in premium. However, I would lose money on the stock. So because I bought it for 157.50, and if I'm now getting called away at 155, which is below my assigned price, I would have a loss of $2.50 per option per stock traded. And again, for me, that's a total of where are we? 1,200. So it's quite a substantial loss. That's what, around $3,000, somewhere around that, right? And this is where you see that my total gain here would actually be $1,500 negative. So I do not want to do that. What happens if I sell, for example, at a higher strike price? Well, here I get much more premium. And as you can see, I get only 12 cents. So I'm making $144 in premium. But as you can see, I would get a lot of money if the stock rises and moves above 160, because here now I would make $2.50 per stock traded. And again, for 1,200, that's what, around $3,000, or to be exact, it's $3,000. So it would make $3,141. So let's just compare these different scenarios. So let's just bring up UPS here again and say, okay, scenario one is I want to sell right here at 157, and let's see what we can get for this right now. So we could get, again, probably around 45 cents. So let's plug this in here. Not exactly my 30%, but you get the idea. So same values here. If we get assigned at 157.50, and we're selling it towards this week's expiration, which is October 6th. And again, we have 1,200 shares, or I have 1,200 shares. I don't know how many shares you have, if any. And here we would choose a higher strike price. So let's say that we would choose the 160 strike price, where we are selling above the current strike price. And then let's go and compare scenario three, where right now UPS, and again, 157.50, October 6th. That's what we're looking for. 1,200 shares, everything else the same. And here now, let's say that we would sell the 155, which is below our assigned price. So let me just show you of what exactly is happening here in these three scenarios. So as you can see, scenario one, we get some decent premium. We get around $540. And we see that the stock gain right here would be exactly $0. Why? Well, we bought the stock for 157.50. We might get called away at 157.50. So we're making not any money on the stock, but we do make money on the option. So this would be a total of $540. Now, for the 160 strike price, we get less in premium, only $144. But if UPS moves above 160, we get an additional $3,000. You see it right here on the stock gain. So this would give us a total of $3,144. And now you might say, well, this is clearly better than this because it is bigger. And you're absolutely right. It is. However, in order to do this, we need to make sure that by the end of the week, in the next 4 days, UPS rallies above 160. Now, right now, as you can see, UPS is trading at 153.87. So is it possible? Yes, but not very likely. So what is a third scenario here? This is where we're selling a strike price below. We get a lot of premium, but if UPS goes above 155, we would have to sell our shares that we bought for 157 for 155, and we would experience a loss of $3,000. So this means that here we would lose $1,584. So which is the best scenario? Well, this where it depends a little bit on your outlook. So if you expect UPS to stay below 155, then obviously this is the best scenario. If you expect UPS to go above 160, then scenario 2 is the best scenario. So let's go back on the chart and let us see what can we expect as we are looking at the chart for an expiration of Thursday. And this is where we have something that we call the expected move that we can toggle on, where we see, okay, right now, based on options pricing, traders expect prices on Friday either to be at 156.79 or to move down to 151. So this is why, for me, scenario 3, where we are selling it below the strike price, since it is possible that UPS, with the expected move, moves above the 155, I don't like the scenario. So I don't know if it makes sense to display it on the chart here. Probably not, right? So this is where I personally also don't think that by Friday we will be above 160. So based on what we see today, for me, it makes the most sense to go with scenario 1, where we sell the 157.50 calls, right? So, and again, it depends a little bit on your outlook. And one of the reasons why I like to use the PowerX Optimizer here as the software is that I get the information that I need in order to, make an informed decision today. So I see that there's a viewer question where it says, okay, if you sell the 157.50 strike and the stocks start to approach it, would you consider rolling the call to a higher strike in the near future to capture more gains? That is always a possibility. And in one of the upcoming shows, we will definitely talk about rolling because it's very fascinating. I do it quite frequently that I roll my calls. I don't like to roll my puts because I want to get assigned, but I do like rolling my calls. So this is definitely a scenario that we'll talk about. Hopefully here with UPS, I have a chance to sell it at 157.50. And then as it approaches and go higher, we might be able to roll this and show this. Excellent question. Absolutely. The one tricky thing with the rolling there is if the stock suddenly jumps. So if this goes very quickly towards 160, you might not be able to roll it. This is why I personally am not a big fan of these so-called kamikaze calls. So what are kamikaze calls? These are calls that you're selling below your assigned price, right? Because why kamikaze? Well, because if you're getting called away, you are losing money. And again, all is good if the stock is just diddling around, right? But if a stock is moving higher, you might not have an opportunity to roll the calls. But excellent question here. Anyhow, so just to wrap it up and to talk about what we have covered here so far, and we're going to bring up my blue pen again. So first of all, I like to trade the wheel strategy. And if you look into the archives, this is where you'll see what exactly this wheel strategy is, how I'm trading it. Number 2, we talked about stock selection. We talked about my specific criteria that I like to use to find the best stocks to trade. Number 3, last week I gave you an example when we talked about selling put options. And last week the example was PM Philip Morris, and that expired worthless. And then, let's actually go here, erase this. There we go, right? Number 4, now we talked about selling call options after you're getting assigned. And this is what we do with UPS. Now, as you can see, it's not always possible to sell call options right away, but here we do have time. I mean, we own UPS, nothing wrong with it. If we would even own UPS, the next time on ex-dividend date, we would get a really nice dividend yield of 4.17%. So I'm not in a rush to immediately get called away. And this is what many traders who are trading the wheel strategy, they expect to get assigned and then immediately get called away. In fact, what I often see that as I'm trading the wheel strategy, that at first, if we are looking at the assigned price of this, at first, I see a dip of around 10% when the stock is going against me. And this is why we're doing the show here, and I'm sharing with you exactly what I do so that you can make a decision if you're comfortable with this. So if we think about it, at 157.50, a 10% drop would be to what, around, that's $15, around 142, right? So is this something that makes you nervous, or are you okay with this? Now, I've been trading the strategy here for quite a while. Therefore, I know that this is possible. I am in positions where suddenly or sometimes it might go down 20% or even 30% against you. I mean, NVIDIA was one of the positions that went 30% against me. Google was one of the positions that went 20% against me. So this is something that can happen. And you need to know before you decide to trade a strategy, what is possible, what can you expect with the strategy, and then make sure that you still like the strategy, even if the stocks go against you, because every trading strategy looks handy dandy and fine, right? When you just see all of the cherry picked examples where everything is running perfectly. But in real trading, these things happen. And this is why it is important, I think, that you know what to expect. And this is why I decided to do the show here. So if you can remove the charts here for a moment and just bring me back on full screen, because that's actually what I wanted to share with you. By the way, do you like my mug? This actually shows you exactly when you should trade, right? So when the coffee is here, don't trade. Right here, getting there. Okay, you can trade now. Yeah. So I'm definitely at a point where I can trade now. I hope you find this useful and valuable. And this is what we're trying to do here with the Tradier Hub, where you have different traders who are showing you different approaches so that you can decide about the approach that fits you the best. Hope that you enjoyed it. If you did, click on like if there's a possibility to do this. Not quite sure if the system is built out this way just yet. And make sure that you're tuning in on Mondays, because I'm here live on Mondays at 10 o'clock Central Time, 11 o'clock Eastern Time. No, sorry, 11 o'clock Central Time, 12 o'clock Eastern Time. And you see, I won't be able to respond to comments that you leave after the show, but I would love for you to be here in the same way as MM79 is here, that we can respond to questions and comments live. Because after all, it's called Coffee with Markus. So let's have a coffee. Let's chat about the positions. Let's chat about your questions, your concerns. I don't know, your hopes, your dreams, whatever it might be. All right. That's a wrap for today. And we'll see you again next week. Take care, everybody.